This presentation is for the January 21st, 2021 Alaska chapter of the IMA meeting. I'd like to go over some recent federal tax changes. I am Dr. Teresa Stevenson, a professor at the University of Alaska Anchorage and a longtime member of the IMA. I am also a CMA. The topics that I'm going to cover in this presentation are the new W-4 form that has just come out that is significantly different from previous W-4 forms, the new Schedule SE that has a part on the end of it for the amount of self-employed tax that taxpayers choose to defer payment on until the end of the year penalty-free. A little bit about some changes to the Earned Income Credit, which also apply to the additional child tax credit, but that I'm not going to discuss directly. Some changes to charitable contribution deductions, and last but not least, just a little snippet on new developments regarding the PPP loans that everybody is talking about. So the first change I'd like to talk about is the change to the W-4 form. A lot of us have filled out the W-4 form when we first went to an employer and they asked us if we were single or married but wished to withhold at the higher single rate, how many dependents we had, we signed it, and that was it. And now, because so many people have working spouses, and because there is a large child tax credit and people have multiple jobs, etc., they are trying to get the withholding to more accurately match your final tax liability at the end of the year. And they're doing this with a little bit more complicated form. There are 5 steps in this form. Let's go through those steps one at a time. The first one is your personal information. Now, this is very much the same as it has been all along, but the big difference here is that instead of asking you if you are single, married, or married but wish to withhold at the higher single rate, they are now breaking this out by filing status. Single or married filing separately, married filing jointly, or qualifying widow or widower, sometimes called surviving spouse, and head of household. The second step, I think, is the one that is the most confusing for most people. And so you only have to do this step and steps 3 and 4 if you have multiple jobs, a working spouse, etc. So this step, step 2, is only for multiple jobs or a working spouse. And you have 3 choices. You can go to www.irs.gov/W4app, or you can use the multiple jobs worksheet, or if there are only 2 jobs total and they're about the same amount of money each, then you can just check the blue box. I'm not going to do the multiple jobs worksheet, but I would like to demonstrate how the estimator at www.irs.gov works. So let's turn to that. So here is the IRS website, and it tells you to gather the information that you need. I'm going to do an example of this, so let's scroll down and see what we need to do. We're going to come all the way down in here. You can read all of this, but let's just go to the use the tax withholding estimator, and we're going to have a married couple, and I'm going to do it for the wife, and we'll just go through and see what happens. So married filing jointly, nobody can claim me as a dependent, but yes, I can claim other people as a dependent. I'm going to have 2 children. Do you or will you or your spouse hold a job this year with paychecks from which federal income tax is regularly withheld? Yes, so that's going to be the majority of us, right, that have our taxes ordinarily withheld. How many jobs will I have this year? Well, I will have 2. I work full-time, I work part-time, and then maybe I'll also have some other income as well. How many jobs does my spouse have? Well, he is more stable than I am. He has only 1. Will I receive income from a pension? Sure, why not? Let's just add it. How many pensions? We're going to have 1 pension. How many pensions does your spouse anticipate? 0. And then other things. So Social Security benefits, scholarships or grants, unemployment, self-employment. So I'm going to just put down, yes, I have some income from self-employment. Other distributions, I'll be 65 or older. My spouse will be 65 or older. I'm blind. My spouse is blind. Let's go forward. My first job, do I expect to hold this job all year? Yes. How frequently am I paid? Let's just say once a month. 12/31/2020. So I get paid the last day of the month. Total wages I expect to receive. Let's just put down 100,000. That seems like a nice round number. Have I entered any bonuses? Nope. Do I expect to receive any bonuses? Nope. My last pay period, enter the federal taxes withheld. So again, I'm just making up numbers. Let's put in $1,800. That should be the amount of money withheld on my last pay stub. Did you or will you contribute to a tax-deferred retirement plan? Yes. How much do you anticipate contributing per year? $5,000. Again, making up numbers. Do you or will you contribute to an FSA? No. Now let's look at my second job. Do I expect to hold this job through the entire year? No, I think I'm just going to work tax season. So I'm going to work from February 1st until, maybe the end of April. And how often will I be paid? Weekly. How much do I expect to receive this year? So that's an interesting question. I need to anticipate the full amount that I'm going to receive. So this is just a part-time job. I'm going to assume that I'll make about $3,000 on tax season this year. And I'm not going to have anything taken out of this. Now they ask about my spouse's job. Yes, my spouse anticipates being paid all year. Let's say that he gets paid weekly. On what date did your spouse receive his most recent paycheck? We'll say on the 8th. And then the total wages my spouse anticipates receiving, $150,000. No bonuses, no bonuses. So I look at my spouse's paychecks. He's been paid twice this year. He had $630 withheld from each paycheck. So that's $1,260. And then per pay period is $630. Did your spouse contribute to a tax-deferred retirement plan? No. HSA, FSA, pre-tax child care? No. And then we're going to look at my pension. Do you expect to receive this pension all year? Yes. How frequently do you receive it? Once a month. What was the date of your most recent pension statement? And I'm going to go back again and just say I receive it once a month on the last day of the month. What was your total annual pre-tax pension payment? So this is the annual amount. Notice that they've asked for how often do you do it, when did you last get it, and then your annual amount. So be careful on this. And this is just a small retirement account that I have from an old job, and I elected early retirement on it. I'm going to put in $1,200. And they don't withhold any taxes. Then we can come down here and we can go to other sources. So on top of all of this, I have royalties. I am an author and I have royalties, and I get $15,000 of royalties, and I didn't pay anything towards self-employment. I would like this to all be covered through my withholding. I don't want to have to make estimated tax payments. So now I'm going to continue with this. The calculator will automatically make your adjustment for the deductible portion of the self-employment tax. And then do you have any other additional adjustments you'd like to make? And I don't, so I'm just going to go to the next step, hit next. And then it says I qualify for a standard deduction of $25,100. Am I going to itemize? Well, we own a home, and if I look at my last year's tax return, I can see that my itemized deductions were $34,000. And so I'm going to break that out in here. So taxes I paid, of course, we know that's capped at $10,000. And then interest I paid, let's call that $14,000, and then gifts to charity $1,000. So this is all from last year's itemized deduction, Schedule A. And go to next. And then I get tax credits for my dependents. Tax credits are amounts you subtract directly from your tax obligation. Do you want to learn more and finish, or get your results without tax credits? Well, let's just see what they say. So I have 2 children. We said that before. Child and dependent care. Nope, I've been working from home because of COVID. and so I don't have any of that. And I'm just going to leave the rest of this blank. Foreign tax credit, educational, retirement savings, homeowner, etc. You can go through each of these individual things if something applies to you, but let's just click next. We can use the slider to adjust the results to wherever we want. I, in particular, don't like to give the government an interest-free loan, so I will choose 0. So then when we're done, it tells us how we should adjust our withholding for each paycheck. So the first one, for the first job, we need to have 1,064 withheld from each paycheck, 736 less than now. For the second job, I don't need anything withheld. For the spouse's job, I need 583 withheld per paycheck, 47 less than current. And for the pension, 0 withheld, which is good because my pension provider doesn't offer that option. So now we're going to go back in and see how to adjust it. And let's just look at the first job. That was the one I was completing this for. It says, check if your employer does this via paper or online. Complete a new W-4 form, and then select married filing joint, and enter $398 in additional withholding per period, line 4C on Form W-4. So picking up where we left off on the PowerPoint slide, I'm going to go to the next slide. We should probably fill this out here as well, but we already did it on the calculator. And then for step 4, this is where we're going to have the additional withholding. We're going to enter that amount, the $398 on line 4C. We're going to sign this, and we're going to turn it over to our employer. Now, what's going to happen is for this particular job, the $100,000 job, the employer is going to determine what the standard amount of taxes that should be withheld for a married filing joint person making $100,000 a year is, and then they're going to add that $398 per month. Now, the IRS website told us that this is still going to be less in withholding than I'm currently having. So this wraps up the W-4. Let's move forward to the next topic. The next tax change between 2019 and 2020 is the Form 1040 Schedule SE. And this is, of course, the form on which we pay our self-employment tax. The short Schedule SE is no longer available, so there is no longer a flow chart at the top of the form that taxpayers have to work their way through to figure out whether to use the short form or the long form. And all taxpayers are now going to use the long form. Parts 1 and 2 of that form haven't changed. I compared them from year to year, and they are the same. But there is a new Part 3 that helps self-employed taxpayers determine the maximum deferral for paying those CETA taxes. And so let's take a look at the new form. It is, again, Schedule SE. The only difference is that there's no SE short form and SE long form. But then the second page, and I blew that second page up a little larger than the first page so you can get a better look at it. Part 3, maximum deferral of self-employment tax payments. And that's going to flow through to Schedule 3. I thought it would be useful to just stop and fill one of these out very quickly. So let's turn over to the fillable forms and do that. So let's just go back to our previous example of the husband and wife. The wife has got a first job. She has a part-time second job that presumably has W-2 income. And then we're going to take her royalties this time and assume that that is self-employment income. And so when I come in here and fill this out, I have no net farm income, and so I can skip that line. And then I come down to net profit or loss from Schedule C. Let's just put in the full $15,000, assuming that that is her actual profit for it. And then we're going to combine the lines, so $15,000 again. And then it says if line 3 is more than 0, multiply line 3 by 0.9235. And we don't want pennies on a tax return, so I'm going to make this 13,853. And again, that multiplication is subtracting out what would normally be the employer's portion or the deductible portion if you were a corporation. And so that's why you deduct that amount. Most people won't use anything on line 4B, and then on 4C, we add this up, 853 again. We don't have church income on 5A or 5B, and then line 6 is to combine these amounts. On line 7, we have the Social Security wage limit for the year, and this isn't going to come into play for people that don't have W-2 income, but if you do have W-2 income, then you have to add the total amount of security wages and tips from your W-2s and put that onto line 8A. In this case, she had $100,000 from her main job and $3,000 from her part-time job. So we're going to put $103,000 in this line. She had no unreported tips, and she had no wages subject to Social Security tax from Form 8919. That would be, again, not a usual event. And so we're going to add lines 8A, B, and C, and we get $103,000. And then subtract that from line 7. And that gives us $34,700. Now on line 10, it says multiply the smaller of 6 or 9 by 12.4%. So the smaller is line 6, 13853 times 0.124. And the Social Security, again, no pennies, 1718. And then we're going to come down and we're going to take the amount on line 11. We're going to take 6 and we're going to multiply it by 0.029. So then on line 12, we're going to sum both of these and we get 2,120. And that, of course, is the self-employment tax that we have to pay. And then on line 13, we're going to add half of that, or 1,060, which is the deductible portion of the self-employment tax. And that deductible portion is going to go on to Schedule 1, but don't forget that you also have to use that in any QBI calculation that you might have. Because this is not a farm, we don't need to worry about the farm optional or non-optional method, so I'm just going to leave those blank. So now we get to this new section, and it says if line 4C is 0, skip 18 through 20 and enter 0 on line 21. But 4C isn't 0. 4C is 13,853. So the next thing is that the taxpayer is going to have to go back to their records and they're going to have to determine what portion of their earnings, or what portion of their profit actually, is attributable to March 27th through December 31st. Now, I think that a lot of your taxpayers are going to have trouble coming up with this information. So let's flip over to the instructions to the form and see what it says. So this says use any reasonable method to divide the net profit or loss on line 3 between January 2020 and March 26th and March 27th through December 31st. So any reasonable method. So if you have actual accounting records, you could go in and you could run a profit and loss as of March 26th, and that would give you your answer. But you may not have records like that, especially the smaller sole proprietorships may not. So it goes on and it says a reasonable method will accurately reflect the time when income was earned or accrued and deductible expenses were paid or incurred depending on your method of accounting. In most cases, a proportional division of the amount reported on line 3 based on the number of days in each period will be considered reasonable. So, in order for this to be reasonable, it needs to be based on the number of days, not based on just a straight like 75% at the end of the year, 25% at the beginning of the year. Also, if you have a large item of income or expense in one of these periods, then this may not be considered reasonable. In order to figure out how much is attributable to that first period, we are going to take the number of days in January, 31, 29 in February, and the first 26 days of March, and put that in the numerator, and then put 366 in the denominator and multiply it out. And that gives us about 23.5%. The complement of that is 76.5%. So that's probably a reasonable ratio to use in most circumstances. Now, we don't have additional guidance on this yet, so I'm not sure how that would play. So let's go back to the form, and it says enter the portion that can be attributed to the last half of the year. So that is going to be the 76.5%. But notice that it says the portion of line 3. Now, this tripped me up when I first did it because our test on the line above is if 4C is 0, and then on line 18, it tells us to use line 3. So line 3 is the full $15,000, and 76.5% of that is $11,475. So that's what we're going to have to enter here. And then it tells us to take that amount times the 0.9235. So this is, again, replicating a little bit what we did on the previous page. And that gives us 10597. And then enter the portion of lines 15 and 17 that can be attributed. Well, if we scroll up and we look at lines 15 and 17, we can see that those are blank because that is the farm method. So we don't need to put anything in here. And then we're going to combine 19 and 20, which is the 10597. And then it says if line 5B is 0, skip line 22. So line 5B is in fact 0. We're going to skip line 22 and enter a 0 on line 23. And then add lines 21 and 23. We have 10,597. And then enter the smaller of the amount on line 9 or 24. So if I scroll back up and I look at line 9, that's the 34,700. This is going to be smaller, 10,597. Multiply that by 6.2%. That gives me $657. And that is the amount of Social Security portion of the self-employment tax on the amount that you earned in the last 3/4 of the year. So that is the amount of tax that a taxpayer could defer payment on until December 31st without penalty under this new law. And then it tells us to take this amount and to see the instructions for line 12E of Schedule 3. So let's continue down this rabbit hole. So then I went to Schedule 3 to see what this is all about, and I scrolled down to line 12, and you can see that on 12E it has a deferral for certain Schedule H or SE filers, and it says to see the instructions. So the next thing took me to the instructions. And when I read the instructions here, it says if you file Schedule H or Schedule SE, you can defer some of the household employment and self-employment tax payments you may owe on your 2020 tax return and pay them later instead. However, you can't defer amounts that you've already paid. So again, this is something brand new, and so I went out to see, well, what are they talking about deferral of taxes? The IRS website, it tells us that this is a provision of the CARES Act. So this is something that I've never seen before, but apparently they are allowing self-employed taxpayers to defer payment of the CETA taxes if they haven't already paid it until later in the year. So what's the difference between a deposit and a payment? What's the period that they can defer for? And this is where we're getting those crazy March 27th through December 31st dates. Those are the dates that Congress wrote into the CARES Act. This also applies to employers. They can defer their share of the Social Security tax on their employees. So this is all part of the CARES Act to let people have a little bit of breathing room, but the taxes have to be paid by the end of the year. Anybody that still wants more information about this, notice 2021-11 was recently released by the IRS. that covers this information about the COVID relief. And if we go through and look at this, we can see that the Secretary determined that employers are required to withhold and pay the employee share of Social Security tax under Section 3102A, or the railroad tax equivalent, and that Notice 2020-65 postponed the due date for the withholding and payment of this tax until the period beginning January 1, 2021 and ending on April 30, 2021. We can continue reading. And then it says that the relief provided by Notice 2020-65 is modified, extending that period until December 31st, 2021. And so this is what this deferral is all about. And then there's more information down here. So this is the IRS guidance that just came out on this subject. Another change in 2020 is that when taxpayers calculate their earned income credit, if they're eligible for one, they can use either their 2020 earned income or they can use their 2019 earned income if it was more than their 2020 earned income. This is also true for the additional child tax credit, but I'm not going to cover that in this video. And this law is in effect because so many people were out of work during 2020 that their earned income may be artificially low through no fault of their own, and this will allow them to take the higher credit. So if 2019 earned income is higher than 2020's, taxpayers should calculate the earned income credit both ways and choose the higher of the two credits. Now, higher income doesn't necessarily mean a higher credit because it's an upside down U shape, and at some point as your income goes up, the credit goes down. Just to give you an idea of the maximum earned income credits for 2020, taxpayers with no children cap out at $538. That's for income between $7,000 and $8,800, and it goes away completely once you hit $15,820. So that $7,800 is the top of the U. Below $7,000, it goes down. Above $8,800, it goes down. We have the same thing for taxpayers with one child up to $3,584, two children up to $5,920, and of course for three or more children, $6,660 this year. This is a lot of money, so it's important that people do it correctly. Okay, moving on to the next topic, charitable contributions. This is, again, something I've never seen before. We used to be able to take charitable contributions off on the front page of the 1040, and then they moved it to the Schedule A, so only people that itemize get a benefit from charitable contributions. But for 2020, they put up to $300 on the front page again if you don't itemize. So it's a 4 AGI deduction or an above the line deduction if you don't itemize. Now notice that it's $150 if married filing separately per person, but it's $300 per tax return otherwise. So there's a built-in marriage penalty here. Two single people living together can each take $300. A married couple can take $300. So it's interesting that this is a brand new law that still has that marriage penalty built in. If a taxpayer does itemize, prior to 2018, you couldn't deduct more than 50% of AGI for your cash contributions. Tax Cuts and Jobs Act of 2017 increased this to 60% for the 2018 through 2025 filing seasons. And of course, we know that many of the provisions of TICJA 2017 go away starting in 2026 unless renewed by Congress. The CARES Act raised this to 100% of adjusted gross income for 2020 only and gives the taxpayer some flexibility. So they can look at each contribution separately and they can either apply the 60% limit or they can raise it to 100%. This lets them still take advantage of other deductible items like mortgage interest and taxes, for example, without losing their charitable contribution carryover entirely. So the last topic that I want to talk about is the forgiveness of the loans made under the Paycheck Protection Program and how those are going to be treated for tax purposes. Originally, the CARES Act of 2020 enacted this Paycheck Protection Program, or PPP, and in certain circumstances, if a person who takes out a loan under this program meets the right requirements, they can be forgiven for the loan, basically changing it from a loan into a grant. And I'm going to also use the word gift here for a minute. So it's sort of like a gift from the government to the taxpayer. When this forgiveness happens, we now have to look at this and say, well, we received income. If we're going to treat that like a gift or a grant, it's not taxable to the taxpayer. And therefore, the IRS concluded that any expenses paid with the funds would not be deductible. Now, this is sort of a mirror effect. This is kind of like the government paid the expenses on the taxpayer's behalf. So the income isn't taxable, the expenses aren't deductible. This sort of makes sense. The IRS reasoning or position was based on Code Section 265A1 that disallows a deduction for any expenses that are related to tax-exempt income. And they basically said that the cancellation of debt under the PPP program is a class of tax-exempt income, and that any payments made from that then fall under that loan. But this was not a very well-received policy. And so when Congress wrote the Consolidated Appropriations Act of 2021, it clarified that yes, indeed, the forgiveness of these loans is exempt from tax, that the forgiven loan amounts are tax-exempt incomes under various code sections. For partnerships, that's Code Section 705. For S corporations, that's Section 1366, but tax-exempt income nonetheless. It also says that the forgiven loan amounts would increase the basis for partners in partnerships and shareholders in S corporations. But then on top of all of that, it says that any expense paid with these funds are going to be treated normally. They're going to be deductible. So this is very interesting, and it is a developing situation. I don't think that we're done hearing about all of this. There are still some issues involved with this logic that may not hold up in the long run. But for right now, if a person takes out a Paycheck Protection Program loan and that loan is forgiven, they do not have federally taxable income. Any expenses that they pay with the proceeds of that loan are going to be federally deductible. But wait, there's more. We have to be careful with this because the different states all treat federal rules differently. Some automatically adopt the federal rules, some adopt them by exception only, some adopt them but have different restrictions, and so the different states are going to have to respond to how they treat this. Now let's just take a look at one example that I have seen recently. This is brand new. So each state is going to have to go back and see how they are going to respond to the new federal legislation. They do this every time there are new federal laws passed. And they are, for example, talking about the changes in earned income credit. They're saying that Wisconsin taxpayers have to use their 2020 income. They can't use the 2019 income. And then the Paycheck Protection Program expenses. Wisconsin is saying that Wisconsin law follows federal law prior to amendments made by the Act. Therefore, expenses incurred that are part of the forgivable PPP funds are not deductible for Wisconsin income and franchise tax purposes. So there are going to be differences between the different states. So imagine an organization that is in a state that conforms to federal law and allows for the deduction versus an organization that is in a state like Wisconsin that does not allow this deduction, there's going to be some fallout about this in the next few years, or some reshuffling of things in the next few years. And that concludes the formal presentation. Thank you so much.